The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invest and Anna Christina from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to today's Investing Short, where we explain one concept quickly and clearly to demystify the world of investing. Today's episode, we're talking about asset class and diversification.
An asset class is a group of investments that can be bought and sold. Common asset classes that we talk about a lot include shares, bonds, property, and cash. Each asset class has its own level of risk and potential returns, and they tend to behave differently under various market conditions. For example,
there's cash, which is usually seen as low risk with low returns. Then there's bonds, which are also quite low risk with low returns, but maybe a little bit higher. So imagine that all of these are a bit on a graph, and we're starting from the bottom left, and then we're going up diagonally. The next one up the list would be property, which is a bit higher risk with the potential for higher returns. And then shares, which are also referred to as equities, and ETFs fall under this, and they're often higher risk with higher growth potential. So potential for higher returns as well.
Diversifying across these different asset classes is a great idea to build a robust investment portfolio. So it reduces your risk, but also gives you potential of higher returns.
So now diversification doesn't just apply to asset classes, but it also means diversifying across other sectors and countries. So such as you can diversify across domestic shares, international shares, and invest in specific areas such as tech or commodities.
Each asset class reacts differently to economic changes, so a mix can help smooth out returns over time and reduce the impact of market volatility on your overall portfolio. I think cash is a good example of this. During the pandemic, our savings accounts, you were earning maybe 2% interest, if that. Yeah, but now you can get 5.5%. So that just shows you how the cash return has changed over the last few years.
And similarly, that works for shares, it works for property. So therefore, if you diversify, if you're holding a bunch of different things, you're reducing some of your risk and you have the potential of returns going up depending on what asset class you're investing in. So some are going to be more higher growth, while others will be lower growth, such as cash and bonds that are referred to as defensive, because you might not want a lot of that fluctuation.
Mm-hmm. Especially when you get closer to retirement age, you'll probably transition to having more bonds and cash in your portfolio. But when you are younger and focusing on building your investment portfolio, you might have more high-risk assets like shares and property.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invest or me at Anna Christina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.